Welcome back, everyone, to Vox Markets. My name is Paul, and I'm delighted again to be able to speak to Jamie Constable of Singers, one of the UK's finest capital markets experts. So welcome, Jamie.
Hi, great to see you, Paul. Not sure how fine I feel at the moment. I mean, it seems like an eternity since we last speak, and to be honest, it has been an eternity in the markets, hasn't it?
Oh, yeah. I mean, we've just had straight off the press this afternoon, only about an hour and a half ago, hotter than anticipated US CPI data, with core coming in at 6.6% versus a forecast of 6.5%, and headline, including energy and food, at 8.2% versus a forecast of 8.1%. So within a bit of margin, sort of like, you know, errors. The thing is, obviously, the market seems to have front run it. That it was going to be a bit softer than it actually came in. And so we've had, in the last hour and a half, the equity futures selling off, the FTSE's gone down, and bond yields in the US have spiked. But that's sort of just that's the price action. What's your sort of your sort of more educated interpretation of that data and what it means for investors?
If you look into the data, what's driving it at the moment? The big drivers are shelter, food, and medical care. Shelter is quite interesting because that's 30% odd of the index. And the way they calculate it, it's almost 12 months deferred. It almost looks back 12 months. So that's going to take a while to drop. But if you look at lots of the other components, they are dropping quite markedly. Used car prices are falling in the States now. House prices are falling in the States now. Lumber's down something like 40 to 50%. So prices from the highs, prices are falling. I think we're in the process of topping out. Now, those numbers, okay, it was 8.2, it was 8.3 last time. They were forecasting 8.1 on the headline. The core, 6.6, that was up from 6.3 last time, but the core does lag a bit on these things. You take out energy and food, does lag a bit.
And shelter was 6.6%, which is 40% of the core, isn't it? So you're absolutely spot on with your comment that it's effectively a lagging indicator.
It is.
It doesn't reflect what's happening at the coalface now.
No, it doesn't. That's the thing. It's lagging. So I think we're in the process of topping out. I think we said before, put my head on the line now, neck on the line.
That's what I like to hear.
The big one is next month. You've got 0.9% dropping out from last year. That 0.9% drops out. I think you could see quite a nice drop off in CPI next month. So that's my big month now. Unfortunately, that data comes out after the Fed meeting. So the Fed meeting's on the 2nd of November. They may well see some early data or something like that. I'm still of the belief that we are there or thereabouts on US rates. Maybe they do 75 at the next meeting. I mean, I think the data's telling you actually, and we got Q3 results season kicks off tomorrow with all the banks in the US. The data's telling you the economy is slowing. Let me put this scenario to you, Paul. If it comes out at say 1.2 down month on month, so suddenly goes from headline 8.2 to 7.
And what will drive that, Jamie?
Well, you've got it's that dropout from, there's not that much coming. Okay, you've got shelter still coming through, but that's going to tail off. The other things are coming out. It's the year-on-year impact you see, the annualization. What's dropping out is 0.9. So for that not to fall, you need 0.9 to come through. For it to be flat, you need 0.9. Okay,
so you mean, it's still going up, but it's 0.9. It isn't. It's 0.9 less than it's 6.6 or
you had,
whatever.
October last year it went up 0.9% month for month. So for now, this month, so for October, this comes out in November. You need a number bigger than that for the month for the year on year to be ramping. So I do think that we are there or thereabouts. Maybe we get one more rate rise in the States. But I think that's.
So where do you think the US sort of like funds rate is going to top out? I mean, the instantaneous response on the market was to put a peak in April 2022 of 4.8%, which frankly isn't. Which frankly is another 1.5%, which is assuming probably 75 basis points, one in November and another 75 in December to get it done and dusted before the year ends.
Nice Christmas present,
yeah. Beautiful. Thanks, Jerome Powell.
Yeah, and I still think we've got one more rate rise. Whether they do 50 basis points next time we get to 3.75, or whether they do 75 and we get to 4. I think then if inflation starts coming off relatively rapidly, the economies seem to be slowing, then it's going to be hard for them to raise rates into that environment, I think. So I do think that we're there or thereabouts on peak rates. I don't see it going to 5. I mean, if inflation is very, very sticky, for that to happen, I think you probably need the oil price to ramp all the way back up again. You need, and obviously the Arabs and OPEC are doing their best to make that happen. But for that to happen, you need inflation to take off again. I see it hard to see why, as we sit today, why inflation is going to take off again from where we are today. So I think we see it coming back. And in that environment, I think it's hard for them to raise rates into a slowing economy with inflation coming back quite rapidly. I think I think we then peak. And my view then, and we've seen it today, let's be honest, the dollar rolls over, which it did when we had the rumors this morning about the budget and stuff, mid 250 and small cap roof it. Every time, as soon as that dollar rolls over, overseas assets, start to UK assets start to roof it. So we're there or thereabouts. Picking the turning point, is always very hard. On a month by month basis. Picking that actual turning point. But everybody's long the US dollar. I think, will they want to be long at the end of the year when they send their fund reports out at the end of the year? If CPI is seen as peaked, I don't think they will. And flows move markets, as I always say. And I think that dollar could...
You've certainly whet my appetite. I mean, I'm loving loving what I'm hearing here. That's for sure. And if you're right, the markets are going to have a great Christmas present. So what you're basically saying is that actually US rates is going to top out at lower than what effectively the Treasury curve is suggesting. That is going to prove the dollar. It's going to weaken the dollar. Which then actually should provide a bit of a sort of a rocket launcher under the equities. Where do you see the S&P 500 say in the next in 12 months time? Nobody knows in the next month. So I think
tech will do well. I think tech will do, but I think 4,000, something like that. I mean, I think to be fair, the markets that will outperform will most probably not be the US because money will flow out of the US markets on that basis with the dollar rolling over. And where's it going to go? Well, it'll go into euros or go into sterling, even into sterling. Sterling might go up as well. So it'll even go into sterling. And as we say, flows move markets, so that will move those assets there. So I think assets that will outperform. I mean, let's be honest, gilts at 30-year near 5%, over 4% on. There's a bit of a danger that bonds start out crowding out equities, which wouldn't be much fun. But equities will still go up because if UK market money comes into sterling and goes into sterling assets, there's not going to be many sellers of sterling assets at these levels. So I do think that, the S&P might go up, but I do think outperformance is in other markets.
Well, if the dollar weakens and also treasuries don't go up as high, then it naturally provides liquidity throughout the world, doesn't it? So that's going to be
emerging markets as well. Emerging markets will benefit.
And I'm with you. I think 4,000 looks a very sensible sort of price target for the S&P, simply based on if the S&P 500 does a sort of like a 218, which I think what analysts are saying for this year, EPS per share, and it's say flat for next year, just for argument's sake. And then in 2024, it goes up like 14% as a catch up as much as anything. That'd be take it to 250. And effectively, 4,000 divided by 250, if the maths is right, is roughly around about 16. So that's pretty much the long term. I think you're absolutely spot on there, Jamie. So I'm loving what you're saying. Now,
we're agreeing a lot so far. Yeah,
that's right. Now there's a circus coming to Redditch just recently, or so in the near term, and I think it's the Tory party actually, but I'm not sure.
I knew you were going to say that. How did I know you were going to say that?
So can you give us your sort of like quick view of the government?
What do I think happens next? I think
the unfunded.
That's what people want to know.
Yeah, it's the first of all, there's two things: the unfunded tax, and obviously we've got this Halloween sort of like spending plan coming from the Chancellor on the 31st of October. So there's that. What's that mean? And then we've got obviously the fallout from the LDI pension blowout on gilts and what that means and how it's going to settle down.
Well, it all stems from one thing, doesn't it? At the end of the day, it all stems from. I'm not going to say what I thought you were going to say. I don't think you're going to say what you thought I was going to say. It all stems from the end to free money. This is where it's all coming from. It's the end to free money that's driven this. Obviously, in the UK, we've now got this specific problem of unfunded tax cuts of 45 billion. Now, the problem for the market was it was almost a tipping point that pushed things over the edge for the market. And let's be blunt, the UK is not a big enough economy or market to fight the global macro funds and things like that. The US probably would be, but the UK is not. So the markets will win in the end. 45 billion unfunded. They've removed the 45% tax. Thinks that takes 2 billion off, so there's still 43 billion unfunded. Some people put it higher at nearer 60. Push comes to what is it? What happens next? Well, the markets will keep pushing. Let's just jump forward then to the LDI thing. Now, don't want to go down the kind of into the rabbit warren of what that all means, but basically you had pension funds had taken out derivative strategies that meant they swapped fixed interest for floating interest. When those floating rates went screaming up and bond yields went up as well, they had to put up more margin on those. So you got into this vicious circle of having to sell the long bonds, which were falling, which fell further, to put more margin up. So that's when the Bank of England had to intervene. Now it was almost a challenge, I think, for the Bank of England saying that we're going to stop at the end of the week. Almost a challenge to the government as well. We're going to stop at the end of the week. Over to you. What are you going to do? Because the unfunded tax cuts are still there. And then Truss came out at Prime Minister's questions on Wednesday saying, I'm not going to do benefit cuts. So again, that just kind of the problem is just there, staring financial markets in its face. Markets, I think, today you've seen bond yields coming back in the UK, coming back down again. I mean, yesterday the 30-year bond yield was 5%. It's back down to around 4.45 today. I think front markets and sterling's been back up to 112 today as well. Remember, it bottomed at 103.5. I think markets are saying that the position is untenable of the government and they're going to have to do something else. There's rumours today they're already in number 10 talking about that. The next thing they'll probably do, I think they might salami slice, taking bits off until the markets go okay. So the next thing they could do is the corporation tax, which of course they cancelled the rise from 19 to 25. That's 18 billion. So that would get them to 25 billion in a hole. And then it'll go from there. If the market's happy with that, the market's stabilised, then they might stop at that. But clearly, they can't go on with where they are. Some of the comments coming out from some members of parliament that the OBR always gets it wrong and stuff are just laughable, really, because, I mean, they appointed the OBR, the government appointed the OBR to put the forecasts in to sense check what they're doing. So that's just, it's all complete and utter rubbish. What I do find quite worrying is that what hurts an economy is uncertainty. Mm-hmm. And what we have now in the UK economy is maximum uncertainty, let's be honest. If you're a consumer and you're there and talking to some of our companies about this, and they've been talking to their managers about that in their retail outlets or whatever it might be, and saying, what's the man in the street saying? They say, well, number one, they heard it's £2,500 gas energy price cap, and then they're told, well, it's not actually 2,500. It might be, but if you've got a big house, it could be a lot more. And they go, well, I don't understand that. Then they're going, I might lose my pension. Well, let's be honest, not that many people have got final salary pensions anymore. So it's all a bit, that's a bit of a sideshow, to be honest. That's the old schemes.
Albeit there is 1.6 or 1.9 trillion pounds worth. Totally. I mean, but it's not insignificant. I mean,
no. It's very significant, and it's a problem that these pension funds have got themselves into. And then they're going, so I've got a 2-year fixed rate mortgage that comes up next year. I'm paying 2.5-3% on it. The tabloids are telling me that when I refinance, it's going to be 6.5%. What does that do for spending in the UK economy? I mean, it stops it dead, doesn't it? I mean, discretionary spending, people just go, I don't know how much I'm going to spend on my energy. I'm worried about my pension, and I don't know what my mortgage is going to be. So the government need to do something, to be blunt. They need to actually get certainty back into the economy so people know where they stand, so we can move forward. And I think that, and financial markets, it's a bit like, I'll show my age now, it's a bit like rewinding to 1992, when we came out of the ERM, when Lawson stood up all morning raising rates. Up they went, up they went, up they went. I think we peaked 16 or something. And then the market's
not as bad as that. I hope it's
not.
No, that was a bad recession.
But no, it was better then. It was better. It all happened in the morning. And then the markets went, this is untenable, this position. And then the markets went up for the next 18 months. Now, I'm not saying we're going to get a trigger like that this time around, but it's clearly that the unfunded, markets and global markets are not happy with the unfunded tax cuts. So something's going to have to give.
Yeah. No, I mean, I'm with you. I think they'll actually probably U-turn on some of the corporation tax. They'll keep the income tax in place. My guess is because
the 19 one. Yeah.
They'll also. I actually think they'll also keep the current budgets, most of the departmental budgets in place, like the NHS, education, this, and the way they're going to square the circle. And I've not heard this, but so this is my own personal opinion: is they're going to take a knife to the actual tax relief on pension contributions for the higher rate tax boys, because I've read it's roughly around about 10 billion a year, so it's not an insignificant number. Is what they effectively give away, and that will square the circle if they walk back the corporation.
Gets them back to about 15, doesn't it? That would get them back to about 15.
And then they'll fund it through gilts or something, you know, just from the short term and bring it back in the longer term. So if I was going to be an advisor to our circus friends down in Westminster, I would say to that, but they're far more esteemed and knowledgeable than me, and they've got.
Of course they are. They're not making a good sign. They're not showing good signs of being that at the moment. Let's be honest. Then you've got the Bank of England as well, of course. Who, what do they do next? Well, the trouble is, what do they do next? I think your question, where do UK rates peak? Well, it depends what the government does. To be fair. Let's be honest, I think they probably need to do 100 basis points in November.
Yeah, it's baked in that, isn't it?
Yeah, that gets you to 325, same as the US, funnily enough. And then you wait and see a bit, because you've got the impact on the economy we just talked about and what the government have done, which is it could be quite severe. And I think going into Christmas, if you think this through with the retailers, and there's some the best retailers are kind of saying they're flat year on year. But that's flat in monetary amount. If you take into account 10% inflation, they're probably down 10% in volumes. Now, if you're a retailer and you've ordered the same volume as you thought this year for last year, you're going to be massively overstocked, aren't you? So you're going to get some huge sales going into Christmas, I think. So it's going to be, there's going to be some big sales coming through. And I don't know about you, but you're on websites and whatever, and you're starting to get the emails now saying we're on sale, flash sale, all this stuff's coming up. You're going to get a lot of that in the next 6 weeks or so, ahead of Black Friday, I think. And you saw Amazon Prime this week. They've done a second Prime Day. What does that tell you about how they're trading?
Yeah, I mean, I wouldn't call it a Prime Day. I'd call it an overstock, get rid of day, because I think most of the actual people in the States are doing that. What's quite interesting, just on that retailer comments, there was there's an online electrical goods retailer, Marks Electrical.
Yeah, Marks, yeah.
I don't know if you saw it, but basically they've seen an acceleration in their like-for-like sales from the first 4 months of the year into the last 2 months. And they put a first half year trading update. And they, in the last 2 months, I think they were up around about 16%, and they're up sort of like 15% like for like. So they're actually seeing volume as well as price increases compared to the market, which is down 20%. So they're absolutely knocking the ball out the park. But interestingly, also what they're seeing is that because a lot of the retailers have been discounting in the first half, they can't afford it in the second half. So actually that's easing off in the competitive environment. The cost of actual putting some advertising online is getting cheaper, but also the intensity of the competition is also getting slightly better, which is quite an interesting dynamic that most investors haven't actually appreciated. But anyway, let's move on. On to sort of like three sort of sectors that are absolutely bucking the trend and are flying at the moment. Let's start with sort of e-payments and Forex. Now, I know it's a Singer's client, but I love it as well. Is Argentex, which is basically a foreign exchange advisory stroke dealer company that helps sort of like large corporates to transact internationally and
SMEs as well. Yeah, SMEs.
Well, not so much. It's between a million and
it's in between mid-market companies. Yeah.
It is, yeah. But so it's got a great client list. Anyway, it knocked the ball out of the park in the first half with sales up 75%. What's your sort of view on that? What's been sort of driving it and seem to be taking market share?
Yeah. But FX volatility is obviously good for FX. I mean, if things are moving all over the place, then it's good because companies need advice on what they should do and how they should use and what they should do with their FX revenues, and if they're exporting, importing, whatever it might be. So that's all good for a broker. Let's be honest. How are they trading? Yeah, they had their Q3 update. they did 92% of our full year number in the first 3 months. So
first 9 months, not
9 months.
first.
Sorry, not first 9 months.
Just going to say that would be
first 9
absolutely
months,
shoot to the line. Say
sorry, first 9 months with 3 months to go. That's what I meant to say. Sorry. So first 9 months with 3 months to go. So you can see there the pressure on the forecast must be to the upside from that point of view. So I do think that they're obviously doing very well. I think there's about 20% upside to our analyst share price target from where we are at the moment, around £1. So I think it's in the right place. Volatility is great, isn't it, for dealers and things and dealers, as long as the volumes are there. But the one thing about the FX market, and what your point about share is key here. They're a minnow in the market. They offer better rates than if you go to your clearing bank, high street bank. They offer better rates, and that's obviously that's attractive. Everyone needs to get every penny they can get at the moment in terms of from corporates. So that's why they can take share.
And they're also expanding overseas, aren't they? Because they've just got regulatory approval in Holland, and likewise they've got it Australia, which has got gilt-edged regulatory approvals.
Proper regulatory approval, rather than operating under an agency or something like that.
Yeah. So, and they're also investing in their technology as well, aren't they? So they're going to turn it into a platform to become sort of like to do mass payments as well as sort of like straight through processing, as well as the sort of the forward and the futures contracts they do for their larger So I'm with you. I mean, just in terms of the valuation, it looks at the trading on about, if you do a 20% upside in EBITDA for this year, which is absolutely not a stretch.
That's 20% to our target price. We haven't moved our forecasts because let's see how they do in the last quarter. But if you do 20% on our current forecasts, you do a 20% upgrade, then you've got more upside than that, haven't you?
Yeah, well, I mean, it basically drives an EV EBITDA multiple of 8 compared to the market on 15. So I think investors, if they want to back a winner that's clearly knocking the ball out of the park, Argentex is one. And in the same area I know I've talked about it before, is EQLS, which is a more of a platform play, and it's more SME rather than, say, larger corporates, etc. And it does a lot of straight through processing. It doesn't. Argentex does about 50% sort of like futures and forward contracts, whereas EQLS does about 10%. So it's a lot less on that. It's more straight through processing. But again, its revenue in the first half increased by 85%, like for like, and he's knocking the ball out of the park and is in the same sort of market, taking market share from the big banks. And I'm with you. They didn't upgrade their numbers at the half year. But I just think both Argentex and EQLS are going to be doing that later on in the year. And if people want to say back winners, then those two seem to be doing surprisingly. Well, not surprisingly.
Well, no, but even ICAP, which has been obviously on the floor for years, even they're starting to get start to come through now, because the volatility is great for those. Let's be honest, volatility is the name of the game, isn't it?
Well, that is that. But I think that rather than volatility, both of those, EQLS and Argentex, are winning most of the growth is market share wins, not transitory volatility. But anyway,
by volatility, I mean people need advice. That's the big thing.
Oh yeah. Well, we all need advice. That's why I'm asking you. Now, when it comes to moving to another sector that I know we've talked about and is worth investors really sort of digging through, because there's some terrific opportunities. It's this whole energy transition. Now, Avingtrans came out with some very good full year numbers.
They did.
Do you want to take us through that one? Because
Avingtrans, we've talked about at length, haven't we? I think before. So I will be relatively brief on this one, but they're in all the right areas. Nuclear,
defense,
aftermarket, which has been their big focus. So aftermarket happens. If capex isn't happening and investment isn't happening, but don't get me wrong, I think that is happening because of reshoring, nearshoring, and everything like that. That's all happening. And let's look at nuclear. Nuclear is now in the investment phase as well. Nuclear is going to happen as well.
Massive.
There's not many people with the accreditations to do nuclear work. Avingtrans have got all the engineers who can do it. So they've got all of those things. Plus they've got the protection of aftermarket as well. And then you've got the optionality of medical there, where they're progressing at speed on that side in terms of their smaller scanners there, which obviously don't need the gases in them. So they're much easier, cheaper for the veterinary, and then for arms or legs or natal stuff like that. So a superb company, extremely well run. as some of the parts, it's over £5, about £5.10.
Yeah,
on that.
mine's 560.
Yeah, so that's the sum of the parts, and that's how you have to look at Avingtrans like that, to be honest.
And
I would,
what,
you know,
there was what on the order book and visibility, because it wasn't in the RNS, and this is why I think it's quite an important one, because you picked up on it quite immediately. You know, look, what the revenue cover for this current year is. It's. I mean, as I understand it, it's from you guys. It's 90% for this year, which is just brilliant.
Yeah. It's that their type of business is that type of business. You see, even oil and gas in there, which obviously for years has been a bit kind of under the weather. That's coming through now as well. So yeah, they've got great visibility. More contracts will come through. You know, under promise, over deliver is really their mantra. And then on top of all of that, you've got, look at the turmoil we've got in markets. Will they find a great acquisition out there that they can go and do to add another leg to the business, or add more to their existing legs to actually drive it to take it to that next level again? And let's be blunt, if you're going to back any management team to buy something and then turn it round, the two Steves are the guys to do it, because
they are.
They've done it. They've done it so many times. So that's a great company from that point of view.
Yeah.
Then another one in the kind of similar space is Eneraqua, which we've mentioned before as well. They had great numbers as well. Upgrades. You talk about revenue cover, 100% to January 23, 70%, low 70s% to January 24, but that low 70s is after an upgrade for January 24. So it was over 80 before. You know, by the time they finish the current year, my guess would be they'll be 100% covered for the new year as well. And why are they so good? They've got IP advantage. Their IP gives them a massive advantage over the competition, because to make it simple, if someone put in a unit that produced 100, they can do it with a unit produces 90. So the cost is a lot lower then, because their IP gives the advantage over flow, etc., etc. Much more complex than that, obviously, but just trying to simplify it down there, because we don't have time to go into it in depth. But that means that when they bid, they're extremely competitive. So
what's that? Have they got enough capacity for them? I mean, they're obviously got a brilliant demand, you know, sort of requirement there.
In terms of, it's whether you plan this, because they got the visibility, because the local authority or the housing association with the big blocks that need and it's end of life stuff. That's the key as well. It's end of life. You've got to replace this stuff, because that gas, you know, British Gas will stop supplying you, because it's so old, or etc. They get the visibility, so then you order the kit. So they put a bit of working capital in, let's be honest, because they want to make sure they secure the kit. And then they've got their subcontractors to remember. Eneraqua sits at the top as the kind of consultancy on the business. Then they've got their group of subcontractors who do the work, who it's great to be a subcontractor to Eneraqua, because you know you keep getting work, you're going to keep getting work, so and they're going to pay you on time, etc., etc. So yeah, that's how they do the capacity. You plan ahead to add capacity in terms of that subcontracting work. There was one pinch point, which is if you're putting in a ground source heat pump, you have to drill all the holes into the ground. Now, if you do it badly and the holes are too close together, you put your stuff down and you freeze the ground. So your heat pump isn't very efficient when you've got frozen ground. So they bought a company that could did the drilling and stuff like that. So yeah, you have to make sure you've got the capacity and plan ahead, and that's what the management are doing. So they're investing ahead of the curve, I suppose, is what we're saying there. So it's on about 10.5 times January 23 on a number that is in the bag with that revenue, with the revenue in the bag. I mean, I think this re-rates to a mid-teens rating as they keep producing the numbers.
It seems to be in the right place at the right time, doesn't it? In terms of
exactly.
It saves people cost.
There are grants. I mean, we should say they do get grants to do this, which help the process. But those grants are set till 2026, 2027. And let's be honest, you're going to have an election before then. And the circus leaders, if they're not going to get in and Labour get in, what are they going to do about promoting this kind of energy saving, replacing old infrastructure, grants? Well, they're not going to reduce grants, are they?
No, it looks perfect to me. I'm totally with you. Another one on the energy transition, which again has been knocking the cover off the ball, is Crestchic, and I've mentioned this one before.
Another upgrade, wasn't it?
Well, that's the fourth time this year, and another large upgrade. I mean, I think I can't remember exactly, but I think the market was roughly around about sort of 4 to 5 million of EBITDA at the start of the year for FY22. It's now at 12, so it's more than doubled. I mean, that just shows you the scale of the upgrades. And this business is absolutely flying. In fact, when you've got a prudent and conservative finance director saying that it's actually, the business is literally flying on video, it's doing well. It's doing well, and it's generating lots of cash. Operating leverage is coming through in terms, particularly because a lot of the actual growth is more of the growth coming through on the hire of the load banks, which are used to test and commission backup power supplies. So it's generating lots of cash. It's the margins increasing, and this over the last 12 months. And it's basically invested in more capacity, and they put a target of 60% an increase in load bank manufacturing capacity to help their rental fleet. But actually, they're going to blast through that one eventually. They don't know. They do probably know, but they haven't publicly put a new target out. But I suspect I wouldn't be surprised if they almost double that over the next, rather than what they were. And on that basis, they've got brilliant demand, and they've got capacity to fill it, and most of it's coming through from rental. And none of the forecasts in the market yet have anything baked in if there's ever power rationing or blackouts in the Europe or the UK. Because if that happens, and you're a hospital, a data center, and you've got to get your backup power supplies serviced and commissioned before those happen, because you don't want them to be failing right in the middle of the storm.
It's a play on two things, and it's electrification of the world, and then it's the current problems we've got as well. Everyone wants to make sure everything works. If you needed to click in to power stuff, so and in a great, you say right place, the right time again. These are the type of stocks you want in this market, aren't they? And I think the last sector we're going to talk about was healthcare, wasn't it?
Yeah. What's quite interesting on the sort of the healthcare is that obviously you can go big cap in terms of sort of like, your big pharma, etc., like that. But a lot of the sort of like the real quite small early stage, which have got unique technology, has been sold off so much that they've got lots of upside. And we'll start with one, Oncimmune. Now, I know it's another Singer's client in terms of, and they've had a difficult last year in terms of it was a fits and starts in terms of the actual order flow. They had elongated lot, but they've now started to get a lot of new orders in, particularly for Q1 and Q2 for their Immuno Insights business that effectively does auto profiling for lots of the big pharma, 15 of the top 10. Do you want to take us through this one, because it seems as though there's lots of upside? And
I think the big thing at the moment, you've got a good new chairman in there who's basically very good new commercial chairman. So I think that number one,
he's got a cracking track record, hasn't he?
Yeah. So that's number one. That's what's happened there. It's all about revenue now and the contract wins coming through. They've got the capacity and everything to do it there. So it's about delivering on that, contracts with pharma to basically use up, because the operational gearing will kick in. And it's all about proof in the pudding. The chairman's there now to make sure that which will help them, as you say, he's got a great track record. And it's all about that to drive the group forward. I mean, it's difficult to say much more than that, because proof is going to be in the pudding, isn't it, really? It's all about delivery now. But as you say, what's happened, I think, is some of these stocks have got caught up in the whole redemptions, small cap, falling down, and retail investors, to be fair, taking money out as well. So that's what's happened with some of these stocks. So stocks like that, got dragged down. Now
another one on the same sort of like with the the diagnostic side is Lunglife, that does not really get much sort of profiling, but essentially listed last year at about 180, and it's dropped down to less than 120 at the moment. But it's actually done everything it said it was going to do in the IPO. It's doing a validation trial at the moment with it's got this early stage lung cancer test that uses CTCs, which is essentially the cutting edge of science for diagnosing patients with stage 1 lung cancer when they can actually do something about it. Now their predictive their predictive positive score is roughly around about 90%. The current standard of care is 60%. So it's going to be a massive improvement. And why you need a good high positive score across all of these is essentially it then tells the doctors if they do get something positive, it tells them they can rely on it and they can do something. So that's why it's so key. And I mean, if you run the numbers, and given this is state of the art and there's nothing out there which is as good as this, then you could easily get £20 a share compared to about £1.20. So there's lots of upside, but it's very early days. There's no doubt about it.
And those are the stocks that have suffered the most. And we talked about long duration stocks historically, haven't we? And they're the ones that have suffered the most in this market. Long duration. If you haven't got a revenue line, it's difficult to it's difficult to put a floor under it, isn't it? Especially when the discount rate's rising, which is what we've seen.
Yeah, but another one which I know is a Singer's client, which falls exactly into that, is Verici, which does sort of like leading edge, for chronic kidney cancer tests.
Yeah, exactly. Yeah, for transplants and things like that. They've had good data on the 2 lead products. They're funded to early 2024, so plenty of cash in the bank. We should get more milestones. What they're looking for now is the coding, reimbursement, that process in the US where you get coding, then you get reimbursement through, and we should get more information on that this year through 2023. And then it's all about the commercialization. We should get first revenue this year. So that's good as well. But until you get to that, it's hard for in the market we're in at the moment, it's hard to actually, you've got nothing to hang a number. You can't put a P on it, let's be blunt. You've got to look forward and then you've got to believe it works. But that's where we are. They're doing all the right things, as you said, a bit like Lunglife. But until they can actually get those revenue numbers coming in and people say, yes, it does work, the market is accepting it, it's got reimbursement in the US, then you go, right, okay, it works. It's a small vertical in terms of what they're doing with the kidney transplant stuff. But the beauty of that, of course, is there's not going to be too much competition. And then in time, they would look to put it into other transplant markets. But to be blunt, if it works in kidney transplants, someone else will probably come along and do that instead, i.e. take them over if it works. They get that.
Yeah, I mean, I think with 2 tests both working and having good positive results, then that says to me it's a platform play because the technology is now. And I think one of the smartest investors in life sciences, Christopher Mills, bought a shed load of shares just recently. So he knows the score. And I did notice that the Singer analyst has given a risk-adjusted target price of 79p versus, and as I say, the shares are probably only about 15p at the moment. It just shows you that type of, it's just one of those, and it's important that investors, there are all these early stage are higher risk, but frankly, the upside is enormous now in them. Another one which has been sold off hugely, and I know we've talked about it, is Venture Life, which is a more of a defensive sort of OTC healthcare products business.
But products, they came out, revenue, it's got everything.
They came out with very good, solid interims that were bang in line with full year expectations, and the shares have just been in the doldrums. They're about 25p, and they trade at less than less than 5 times EBITDA, and the sector's on over 10. So when you look at that sort of through the lens, it's not a surprise, if they, looking forward into 2023, if they hit their numbers in 2022 and then, just get a reasonable amount of modicum of growth in terms of the supply chains, easing off, which is what's happening, then you could see these ones really go, very strongly.
I think that's the thing. We get positive flows into markets. We get, rather than the negative, to be blunt, we've seen for quite through most of this year now, isn't it? Let's be honest. You get monies coming in, and these stocks will move quite quickly. And I think the price target, these Singer's price target is 65p on it. So I mean, and that's modest anyway. So the problem is not the problem, the opportunity. Opportunity or problem is the same. The issue at the moment for people is there are so many stocks out there. Fund managers are looking after their own, as it were, to a degree, in terms of if they hold a stock, they can look after their own before they look at new. So, but once you get the confidence coming back and the flows come back, then they'll be looking for new holdings, and these stocks won't stay down for very long.
I'm with you. And the final one, I know you love, is basically Orphan. Well, it's changing its name, isn't to Vivo, I think, changing
its name to Aviva, yes, because that's their operating company, to be honest. I think we've mentioned this before. It's just a great company. I mean, as one investor said to me, you might know Ergomed.
Yes.
So Ergomed used to have a drug business with a drug discovery business within it. So it was a CRO, a testing business with the drug. Now, Ergomed then farmed off its drug discovery business and concentrated on being a CRO, and it's now a £600 million company. What's Open Orphan done? It had Poolbeg in there, and Poolbeg's gone off, and we like Poolbeg. It's in the right area. It's it's in that anti-infective space. We like that. We initiated on that stock today, so we like Poolbeg. But let's put Poolbeg by the side at the moment to talk about Open Orphan. So now Open Orphan is a pure play CRO challenge testing, which basically means when you're at university, you went along and you did a test. It sounds a bit weird, but you go along and you get infected with flu, even malaria, and they take the drug and they see whether it works or not, or weakened versions of those. But let's not. So you had a new chief exec go in here, Mo, who's come from private industry where he's been very successful in the CRO space. He's gone into Open Orphan, and you just have to look at the numbers in terms of how he's taken this business, grabbed it by the lapels, and is just shaking it and driving it forward. And you're looking at margins here should move to mid to high teens in time. You've got revenue ramping hugely. There's big second half waiting, but let's be blunt. Second half waiting is because they're booked. The drug companies have to book their space. They pay 10 to 15% non-refundable deposit to book their space using their
facility.
Study facility. They will go international facilities in due course, I'm sure. Not at the moment. They've got plenty of capacity in the UK. They work for 5 of the top 10 global pharmas. So you've got to be doing something right for that. And challenge studies aren't part of the approval process at the moment, but they're increasingly becoming part of the dossier, if you get what I mean, in terms of, you think about it, you do a phase 2 study and it looks okay. Before you go to the extraordinarily expensive phase 3 study, you could do a challenge study for a flu drug or something else in their repertoire, relatively cheaply, $20 million, $15, $20 million. And if it doesn't work, you failed cheaply. If it does work, it's brilliant because you now know what the kind of dosing you need to use, whatever, and you use that information to go into your phase 3. So it's increasingly becoming part of the repertoire used by big pharma, and they're in the right areas at the moment. Our virus is going to go away. Unfortunately, they're probably not. We've seen Omicron has come back again in this autumn. Will it come back in the winter? Hopefully not. But viruses are here to stay. They're in the right place, and they're expanding. As I said, they do other challenge studies as well. So a great stock. I'm
with you. I mean, I think,
it's 9-10p at the moment. I mean, you could easily see it trading at 20p on a 12-month view, easily.
Yeah, I'm with you. I mean, I think, if you look at sort of like the benefits to the big pharmas in terms of challenge, it accelerates their whole drug discovery and their preclinical trials. And de-risks. But also one of the big problems of doing preclinical trials, say in a hospital, is your patients don't regularly turn up. As in, like, they might be ill, they can't get in, or you just can't get reliable information. They drop out of studies because they've got other things. These things you get locked in, as in, like, challenge study. You get voluntarily. No, I know, yeah, but I mean, you
get paid for doing it as well.
You get the answer that you want in a clinical study faster than you would do normally. So it's great in that respect. Now, just coming quickly on to the Poolbeg Pharma, which was spun out of it, I actually did speak to a really astute fund manager last week, Ian Staples of Schroders, who was singing the praises of Poolbeg, because they've got some quite good, excellent value catalysts coming up for their sort of like new drugs and stuff that essentially treat. They are infectious diseases. Their lead candidate, as I understand, if I remember rightly, is for serious influenza, which frankly kills tens of millions of people worldwide. I mean, it's one of the biggest killers, people don't recognize. So and also what it does is that it will help in terms of sort of like treating on. There's other conditions as well. I think I can't remember. Is it long? I can't remember what it was. There's another one it treats as well, which is really important. So it's got lots of value catalysts.
Yeah.
And I think people should have a good look at that, because it's only about 5p when I last saw, and he was definitely positive on it. So both.
You got management who are very experienced in terms of commercialization there as well. So that came out. But I think what was good is you've got two companies now, but they're focused companies, which obviously always helps.
And I think what Ian was saying, Poolbeg have got access to 20 years of the efficacy clinical data that is supplied by effectively Orphan. So that gives them a real sort of USP and differentiator in the market for that type of drug development.
Yeah.
Brilliant. Well, I hope we're going to still have a smile this time next month. And we've obviously the market's taken a bit of a bath on the US CPI data, but
I'm surprised at that, to be honest. I mean, because going into the numbers, no one was expecting a good number. I didn't think people were expecting a good number. Let's be honest.
They were, though. They'd front run it.
Well, I think people after the PPI and everything, but it's just the weight, isn't it? I mean, everybody's looking for this top in inflation in the US. We all know what's going to happen when it happens. But until you get there, it's kind of disappointment, isn't it? Markets don't like being disappointed. So anyway.
Well, as you say, October CPI coming out in mid-November should be a real sort of
that's my one. That's
where the rubber hits the road, basically.
I think so. Yeah, totally. And we'll see who's in government when we speak next.
Cracking, Jamie. Thanks for speaking.
All right,
and we'll chat in a month's time.
Cheers.
Bye.
Bye.